Includes our next guest as well, CalPERS Chief Investment Officer Joseph Deere. He is joining us now from Washington. Joe, we're glad to have you on the program with us. So you want more regulation, but just not from the Fed. Who should do it if not the Fed?
Well, we propose an independent body, 3 to 5 members, appointed by the President, confirmed by the Senate, whose sole responsibility is the oversight of systemic risk in the system. All information from relevant market players would go to this organization. It would have the ability to then compel regulators, the existing regulators, to act or explain why they're not going to act with respect to conditions that give rise to concern about overall levels of risk in the system.
What makes you think that this other body would do a better job than the Fed? And I mean, who pays to create it? I mean, don't you worry about more bureaucracy?
Well, the question with respect to the Fed is they've got a big job already. It's universally recognized, I think, that we had a major gap in our system by having no one responsible for looking at overall systemic risk. If it's not going to be possible to have a high enough trust level in the Fed for the Congress to give them that grant of authority, what's the next best idea? The other idea that was out there that we looked at was this so-called College of Regulators, a group of existing regulators as a committee trying to act, and we didn't think that was going to work either. So we've tried to synthesize the best, put an independent board together, give them the authority to compel action by other regulatory agencies, and keep them independent.
What is the #1 guideline or restriction you would like to see put into effect? More uniform accounting for derivatives? I know that's come up in some of your literature.
Well, there are 3 parts that are really important. You've got to strengthen existing federal regulators. They need independence. They need resources. Second, we need to close the gaps in the regulatory system. You mentioned OTC derivatives, mortgage securities needed, asset-backed securities needed. The rating agencies need to come under better regulation. And we need to improve corporate governance. The next line of defense after the regulators are the boards of directors of companies, and investors need additional protections there as well.
Joe, it's Betty here, just joining Deirdre. I have a question. I want to switch gears a little bit because we've got a story out about your fund suing the rating agencies for your investment losses. I think about $1 billion of those losses. Tell us, I mean, how do you attribute the rating agencies to your losses exactly?
If you look at the model we have for the performance and function of the rating agencies, you can see it's broken. The issuers pay. Well, that's a conflict right there. Huge fees are earned by the rating agencies as a process of issuing their ratings. So they have an interest in getting things out. The investors who rely on the accuracy of these regulations can be stuck, and there's no accountability in the system. We've taken action in California State Court against the 3 major rating agencies in relation to 3 structured investment products that we had in our portfolio that look like they're going to cost us more than $1 billion in losses. This is going to be a difficult suit to prove.
How much in damages are you seeking, Joe?
We didn't specify the damages. This is way more about accountability and trying to show that these entities have to have some accountability for the quality of the work they do. They just can't issue an opinion and then skate scot-free, even if they're totally wrong, which they were with respect to these securities.
Joseph Deere, we thank you very much for joining us. Joseph Deere, the CIO of CalPERS.